Hello everybody, my name is Elish Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending March 4th, 2020. Looking at the indexes for the week, the Toronto Stock Exchange and oil are up. The US indexes are all down. First, the big news. To no one's surprise, the Bank of Canada raised its benchmark interest rate by a quarter point to 0.5% on Wednesday, a move that's expected to be the first of a series of small rate hikes this year in an attempt to tame inflation that has risen to its highest point in decades. It's the first time the bank has raised its rate since 2018. Before the pandemic, the bank's rate was 1.75% before it was quickly slashed to 0.25% to help the economy. The bank acknowledged in its announcement Wednesday that inflation is heating up even faster than anticipated. CPI inflation is currently at 5.1%, as expected in January, and remains well above the bank's target of 1 to 3%, meaning 2%. Persistently elevated inflation is increasing the risk that longer-run inflation expectations could drift upwards. Currently, the bond markets are indicating expectations of inflation in the short term, but haven't decided on there being inflation in the long run, as indicated by the yield curve. Tuesday, the Canadian GDP rose 6.7% annualized for the fourth quarter, year over year, so the economy is healthy and able to take the rate hikes. Lenders are already starting to raise their lending rates. Bank of Canada is also considering allowing its holdings of Government of Canada bonds to begin to shrink, but this is a secondary method of attacking inflation. The resulting quantitative tightening, QT, would complement increases in the policy interest rate. This will be data dependent. The danger is that it takes 12 to 18 months for the interest rate hikes to affect inflation and slow the economy, leading to additional hikes when the first quote unquote isn't working, and causing a recession in 18 months when all the raises do start working. Because reducing inflation will also hurt the economy, we'll need to keep some inflation, perhaps 4%, to keep the GDP growing. This is a fine line to walk. Turning to the Russian invasion of Ukraine, it is being considered a drag on the US economy, especially the higher prices of oil and gas, which will contribute to inflation. Canada is one of many countries, as well as the US, that have pledged to no longer import oil from Russia. But one of the impacts of that move is to cause the prices to spike. The price of the North American crude oil benchmark, known as the West Texas Intermediate crude, topped 112 per barrel, its highest since May 2011. U.S. oil jumped on Wednesday despite plans to release 60 million barrels of oil reserves. Experts think that $150 oil is possible. In the US, there's 40-year highs for inflation. Consumer prices increased 7.5% from a year ago in January, year over year. As a result, the war may cause 1 to 3 less interest rate hikes than would have otherwise happened, since it is a drag on the economy via the higher oil prices. In the US, where up to 7 increases were suggested by experts, seems to have been lowered to 4 or 5 for this year, 2022. It's also less likely that supersized, meaning 0.5% interest rate hikes will happen, especially in the US. On the alternate side, the war is causing more inflation with the increasing oil prices, possibly necessitating more rate hikes. It will all depend on the data coming in. And of course, there is a stagflation danger due to a slowing economy with the interest rate hikes and higher costs, and the ongoing inflation of prices. The central banks will have to walk a fine line, as I mentioned. Russia and Ukraine have oil, gas, wheat, corn, and mineral exports, which are being taken offline, increasing their costs. Increasing interest rates won't fix the higher prices, whether caused by the war or by the ongoing supply chain issues. The US also added 678,000 jobs in February, more than expected, and their unemployment rate fell to 3.8%, showing the US economy is strong and can take the interest rate hikes. US initial jobless claims did fall short of expectations at 215,000 this past week, however. There is a big worry of Russians hacking of Ukrainian and, closer to home, Western infrastructure. One hacker can do as much damage as 10,000 soldiers when they attack and shut down things like electricity and other infrastructure items. And closer to home, Pembina Pipeline Corporation on Tuesday announced that it has entered into definitive agreements with KKR, which is a private equity firm, to combine their respective Western Canadian natural gas processing assets into a single new joint venture entity called NewCo, which will be owned 60% by Pembina and 40% by KKR's global infrastructure funds. This is significant since companies are still willing to invest in oil and oil-related infrastructure, since there are opportunities rather than divesting themselves of the quote-unquote dirty energy. Scotiabank and other Canadian banks reported this past week, and Scotiabank and BMO joined their rivals on Tuesday in beating profit expectations, broadly based, across multiple divisions in each bank. And on a personal note, I find it interesting how fickle the media and therefore the investor is. COVID has been out of sight for the last few months, first replaced by inflation fears and increasing interest rates, and now by the war, which only coincidentally causes inflation. So that has been my thoughts for the week. Next week, we have smaller companies continuing to report earnings. On Thursday, we have the US Consumer Price Index report, and on Friday, we have Canadian unemployment rate for February. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.